I can own those policies on them. My goal someday is if I pass away, they will inherit those policies with hopefully a lot of cash value, also with a really nice life protection policy for their own families. So I think it can work really well, because if I need to in retirement, I can pull money from those policies, even though it's on their life. I can go in and I can use those funds for myself. So it's a lot of planning, it's a lot of structuring the right need for you, making sure we meet goals. And like I said, working with Randolph so that we can look at your individual situations. Any other? Mm-hmm.
With the cash value policy, is there like a term, let's say if someone is cash, front loaded with a lot of cash, is there a limit to when you can actually access that cash, or is it kind of like immediate?
No, so I will say Mutual does not have a structure that works well. I call it like a single dump in. I inherited a lot of money, I don't need it, I've heard this, can I just throw it in the policy? We don't have a policy that works well for that. So what I like to do is say, let's take that money that you have, let's put it into like a 5-year or a 10-year immediate annuity. Make sure you're getting that guaranteed growth. Make sure every year that check can be your premium payment. And then that way you fund the policy more efficiently. If you dump a big amount into a policy, it makes the face amount really big. And then the next year, if you aren't putting that same amount in, then the face amount cost is eating away at your cash value. So it's just not an efficient structure. You would have cash to borrow from. I just worry for people, they could have a lot better result if they use the asset the right way. So I would always look at life insurance as a long-term asset. Let's at least, so there's a rule. Have you guys heard of modified endowment contracts? It's a term, a MEC. Yep, you don't want a MEC as cash value life insurance, because a MEC is taxed like an annuity. Even though it's life insurance, you broke a rule, so you have to pay taxes when you take money out. So that MEC rule is a 7-year term that calculates how much premium can go in a face amount and not violate the rule. So I always tell people, think of that rule, why it was put in place. It's because you really should consider at least funding 7 years before you start trying to use this policy. And think of it in your mind, like, can I commit to this for 7 years? If you can't, I would use a Roth, because Roths, there isn't going to be a negative consequence if you don't pay your contribution 1 year. I could get into the expense differences on policies too, but I know I'm way over my time, so.
It's very good, very good.
Okay.